everybody, and welcome back to the Oil and Gas Rundown live here at King Operating. My name is Rachel Griffith, and I'm a Senior Vice President here. And of course, joining you live every Wednesday to talk about oil and gas, our industry, and of course, what is happening in the world right now geopolitically. That is a big topic on everybody's mind. And joining me today, of course, our founder and CEO, Jay Young. Hi, Jay, you over there?
Hey, how you doing, Rachel?
Doing good. And
Good.
today we also have with us our executive of tax, Rex Gifford. Hey, Rex.
Hey, how you doing?
Good. Thanks for being with us today, gentlemen. And of course, Jay, the topic on everybody's mind really is Iran. And of course, what is going on in the world geopolitically with the war, oil prices. I know that you have been on countless different news stations and interviews in the past 12 days regarding all of this. So let's just look right now at some of the huge swings that we're seeing in prices, particularly, and all the headlines surrounding Iran. How is that really playing into the market right now, Jay?
Yeah, I think that's one of the most important questions that I get, okay, so why does the Strait of Hormuz have anything to do with me, and why am I going to my gas tank or filling up and it's $10 to $15 more at the pump? Why are those two things? So, number one, we have a tremendous amount of oil that flows through the Strait of Hormuz, which is a canal that's about, I get different numbers, 25 miles, 33 kilometers. That's how thin it is through there. And all the oil that comes out of a lot of OPEC countries, Saudi Arabia number one, goes through this canal. And any disruption, which means that there's tankers that aren't going through there like they were before, disrupts the industry, because 20% of all oil that we consume every day goes through this. And any disruption, especially 20%, will send prices a lot higher. And so, because India needs that oil, China needs this oil, Japan, this is where this oil comes from. If they don't get it from over there, then maybe they don't sell us as much, or we don't have as much, or we have to sell them oil. It just becomes a pretty much a turmoil with a lot of what's going on, because you want to make sure that we have the oil necessary, because the demand is going nowhere. It's going to stay up. And because it's going to stay up and we need that oil and we don't have it, prices are going to go up. The same thing's going to happen. I know you're probably going to ask me about what happens after the war, but after the war, the same thing's going to happen. We're going to need oil. We're not going to have it in the United States because, number one, we're not drilling for it. Number two, the wells that we already put online now declined. And so production is going to go down in the United States. And so number three, demand is going nowhere, and if demand goes nowhere and we need the oil and we don't have it, what's going to happen? We're going to pay more for it, and that's exactly what we're going to do. It's a cycle. It's a never-ending cycle. Oil prices have averaged $78 a barrel, 5, 10, 20 years. The last 5-year average, 10, 20-year average, $78 a barrel. Billy Bob likes it at $75 a barrel. We like it at $75 a barrel, Billy Bob, and that's a good price. It's going to go back. But after the war, it's going to come down, and when the price does come down, people have said, is it going to come back down to the 50s or 60s? I said, no way. We don't have the oil here. Number four, the fourth reason why prices could go up is the geopolitical risk. No idea that it's going to be such a factor this in March. February 28th into March is a factor. Trump said yesterday, if they start striking tankers in the Strait of Hormuz, we're going to hit them 20 times harder than they've ever been hit. And, you don't take that lightly. When President Trump says something like that, you don't take that lightly. You're thinking, man, I'm shaking in my boots. And I told his son takes over. He just lost a mom. He just lost, a wife. I think a dad, a mom. He lost members of his family. He's taking over now, and if he's taking over, I think he's got an axe to grind, right? He's got something that he wants to prove, and I would not I wouldn't take it lightly either. I would not take him lightly, and that's why we're still at war. You know, everybody says the war's almost over. No, it's not. I mean, we're still sending missiles over. You know, Israel and the United States are still collaborating on going into Iran and doing things there, and we're not at the end of the war. We won't be for a while. And as you see this, you're going to see prices, you know, continue to go up. And as it does go up, it affects the American people because, you know, you're going to pay more at the pump. They're like $7 or $8 in California for oil or for gasoline. You know, we saw, you know, 2 or 3 months ago, went to Oklahoma. I saw $1.92 at the pump, and $1.92, and 12, 13 states were below $2. And right before the pandemic, or right before the war, you know, we had gas $2.50, $2.60, $2.70. It's going up. Now it was $3.08 last weekend, which has been a few days since I've seen it, but I do know it's going to go up. It's going to continue to go up. We're going to see prices go up, and that's just the way life is in today's world. When you need oil and you don't have it because we're not producing it, it's the economics 101. It's a cycle. It's going to happen. We're going to see higher prices. So today is a good day to look at, you know, participating in any oil and gas because you want to buy low, sell high. You want to participate in things as they are cheaper, and it's cheaper now than it will be 3, 6, 9 months from now. So we definitely need to, or you need to look at it now, because if the price goes to $125 a barrel, which is what Billy Bob said and Landman, if it goes to $100, $125 a barrel, everybody's drilling. Everybody's going. You can't buy pipe. You can't buy, you know, you can't get a rig. You can't cement, service. Everybody's sold out. So you want to do it now and lock in these prices, which we've done as a company, because I'm not an economics major, but I know what buy low, sell high means, and we're in cycles. We're going to see these prices go up.
Yeah, absolutely, Jane. I think you brought up just a really great point that, you know, as much as we might believe in Trump and he believes the war is coming to an end, and he has obviously the capabilities to do a lot of damage to Iran. Iran is not relenting. Iran is not backing up right now. We're saying, hey, we want to come to the table and talk about this and make some agreements. So it really does, you know, spread this out over a longer term of seeing how this actually plays out and how it continues to affect, you know, not just oil, but other things that go through the Strait of Hormuz. I mean, fertilizer, aluminum, all these things kind of disrupting economies, but really looking at the Middle East. And I know, Jay, that the Saudis, Qatar, they've all had to slow or stop production right now. Mm-hmm. And even with, I think what the IEA is saying, they're going to try and put out some emergency reserves. Jay, there's just not that many reserves out there. Is that correct? I mean, America doesn't have a lot of reserves even at this moment, because we haven't been, like you said, we haven't been drilling. What does it look like reserve wise? I mean, how much is even available in a reserve situation?
Yeah, it's a good question. And the strategic reserves in the United States before Biden tried to suck it all out with his election 4 years ago. Well, he has 400 million barrels that Trump has filled back up, and he wants to continue filling that up. But the thing is, with the strategic reserves, that's 20 days. We need 20 million barrels a day in the United States. 20 million barrels a day. We produce 13. If we quit producing oil in the United States, that's 20 days worth of oil, and then we're completely out, 100%. Mm-hmm. So we don't need to get into here. I see Trump doing it if we need it, because if prices continue to go up, Trump may say, okay, let's let some strategic reserves go. It's all political. And the challenge with that is you can only let 1 million barrels a day go out. I mean, it's not like you can go and, you know, go up, back your truck up, get 4, 5, 6 million barrels and you know, take it to the gas station. It's not that easy. You know, so 1 million barrels a day is what you can get, number one. I mean, number two, it's also good you know, drilling is good for the economy. It's good for jobs. It's good for the trickle-down theory of economics, because if we are drilling for oil in the United States, in Texas, you know, it is good for the economy. It's good for, you know, people to pay for restaurants. If people are making money, they're spending money. If they're not spending money, hopefully they're not. If they're not making money, hopefully they're not spending money, or they go broke. But I did that back in college. I was spending a lot more than I was making. But anyway, that's a different story. In today's world, hopefully people, if they're making money, and if they're making money in the oil field and old jobs, which oil and gas does create a tremendous amount of jobs in Texas, in states that have oil and gas. It's really good for restaurants, donut shops. I mean, car dealerships. I mean, everywhere, because people, they like to spend money and have nice things. And if they're employed, chances are they have a better shot at buying nice things. So that's kind of a answer to your last question. I kind of brought into here, if you don't mind, there, Rachel. So
no, it's perfect. It does. I mean, the oil and gas industry definitely creates a lot of job growth and a lot, gives the economy a nice boost when we're able to drill and get those rigs running and get all the downstream, upstream, midstream staying alive. It is a huge impact on our economy. So absolutely, Jay. Well, this is something that we are obviously continuing to watch very closely here at King, as it's, anytime there's disruption in the market, as Jay said, or anytime we see prices clipping $100 a barrel, it draws a huge amount of interest to the commodity space, which rightly so. When you're looking at your portfolio, if you're an investor and diversifying your portfolio, I think, this past 12 days shows a really good reason why healthy diversification into alternative assets like oil and gas can help hedge against some of these times when we see the market dipping, we see the volatility going down in some of the stocks, that crude prices just continue to tick upward. And so having a portion of your portfolio allocated into oil and gas, extremely important, especially these times. I mean, Jay, we've already been seeing double-digit returns for our investors, but we know the next few months is probably going to be an incredible opportunity for an acceleration of capital back to them. And I would like to invite anybody who wants more information about our opportunity here at King, just to make sure you visit our website, kingoperating.com. You can fill out a request form right there if you're interested to learn more about how you can be a part of what we're doing here. So with that being said, I want to talk a little bit. I mean, Rex, it is March, and there is a date that is up and coming called April 15th. Look at your smile on your face. Everybody in the tax world knows that April 15th is tax day. So Rex, let's go ahead and just segue and talk a little bit about what are some things that investors should really be thinking about right now, when it comes to taxes and energy investments.
Well, there's two major concepts in effective tax liability mitigation. One, of course, is the deferral of income, and the second, of course, is the acceleration of deductions. And by investing in oil and gas, that is one of the best mechanisms for accelerating deductions. And the primary way that you do that is the two entitlements that generate those deductions are both intangible drilling costs, which is anything you can't touch or feel that is required in drilling a well, and then also the equipment costs or the tangible costs that is used to drill a well. So hypothetically, if someone made a capital contribution to one of our sponsored programs of $100,000, the first year deductions would range somewhere between 78 to 85%, or a round number to use for planning purposes would be 80%. So basically you would have $80,000 worth of deductions. So using, again, good, effective tax mitigation strategies, you basically could accelerate deductions by $80,000 approximately by participating in one of our programs for $100,000 or more. So the main thing about, again, effective tax mitigation strategies is you have to realize that timing is the key. Anyone that wants to affect the 2025 tax year other than a few other alternatives, such as making a IRA contribution or others, unfortunately, the time is lost. In considering IDC specifically, for instance, which basically says that IDCs are deductible whenever they're paid or incurred. So if you want to take deductions in 2026 before December 31st rolls around, you need to participate and become a partner or acquire working interest and then drill wells to develop that working interest. For 2025, unfortunately, you've missed the boat. So again, what you're trying to do is manage your 2026 tax liability. And one way of doing that, of course, is to accelerate the deductions by participating directly at the wellhead and participating in oil and gas.
Absolutely, Rex. And like we would say right now, you do not need to wait till December 31st to invest in oil and gas. Don't come to oil and gas just for the tax deduction. Okay. Come to it for a solid investment. Come to it at a time. I mean, right now, honestly, is the ideal time to get involved. For us, our fund is already producing. So wells are already online. Production is already going out. Revenue is already paying out. Prices, for oil is incredible right now. Right, Rex? So, hey, we would say get on the boat now. Don't
Most
wait.
definitely.
Well, hey,
Don't wait for the boat.
The best oil and gas deals are sold in March. I mean, it's not sold in December. Anybody can sell an oil and gas deal in December. So you got to do the ones in March, February, March. Plus, at our rate, we feel like that we're going to have about a 10, 15, maybe even 20% return this year on that. Mm-hmm. So cash flow wise, you're going to need tax work. So put some in now. You can put some in later if you need to, but put it in now because you're going to make 10 to 20% this year. So why not? Don't throw that dividend away. Go ahead and get in now so you can have that for later on. You
absolutely
put in $200,000. That's what, 20 grand, 30 grand or something.
Yeah, don't throw 20 grand out the window. I mean, that doesn't make sense.
Yeah, and being one of the best oil and gas deals ever on the planet. Which the best deals are sold in March and April, not in December. Anybody can put a tax deal together in December.
That doesn't make sense. As a smart investor, you want to capitalize on opportunity, you want to capitalize on revenue, and then the tax deduction is the cherry on top, definitely for sure. But hey, you want to take advantage of a fund that, ours is already double-digit returns for investors. Already cash flowing, already producing 2 new wells. And Jay, we've got 2 new wells that should be coming online hopefully in April. I mean, bam. This is like,
well, yeah, but we're also going to have 2 more wells in April and May, but we're also going to have 1 well a month go on after that. We've got a rig that's getting ready to start drilling in the Mid-Continent in Ochiltree County, Hansford, living up that place up in the Panhandle. There's 6 counties up there that we concentrate on and have a really good team that is concentrating up there. But like in Ochiltree County alone, there's been 7,000 wells that have been drilled. So we definitely know where the oil is and isn't. We're not going to take risk. We're not exploring. We're just going where the oil's already been found. We're using new techniques, some AI, some new techniques to get to the oil and gas and produce it. So we don't have to, like I said, it isn't sexy. It's a 2-to-1, 3-to-1. If prices go up, we can use some leverage. We can double digit those returns, get 3 to 4 to 1 returns. But we're excited about both places that we're concentrating on right now, which is the Mid-Continent region of North Texas, like the Panhandle of Texas, not just North Texas, but also Bivens Ranch. 2 wells drilling there right now. I'm supposed to be on with the Bivens family right now at 2:20. At 2:00, I'm supposed to be on there. I'm gonna have to leave after this so Rex can finish up. But
Yep.
The Bivens family is an incredible family with hundreds of thousands of acres of land, and they work very well with us. We're a great mix operator for them. They like us. It's Nolan Ryan's, daughter's husband, Andrew, that we deal with 100% of the time, but the Bivens family comes together like once a month, and they're on right now with our group, talking about the last 2 wells we drilled, and the next 2 wells, or the 2 wells we're drilling right now, but also the next 100 wells that we could drill. Literally drill 10 wells a year for the next 10 years out there. So it's an incredible property. So I need to go out. I need to go right now so I can reach over, talk to them, just say hello, and try to get in the conversations. But
absolutely, Jay. Well, thanks so much for joining us, and make sure you tell everybody from the Bivens family that we love and appreciate them.
Absolutely, I sure will, Rachel. Thank you very much, Rex. Good
All
job.
right, thank you, Jay.
And hey, don't let that jacket fool you. Rex has got his sleeves up 100% doing those K1s right now. He's got his
That's right.
He's taking a little rest right now, but he's working 24/7, plugging those numbers in so everybody can have their K1s ASAP. But he's also answering a lot of tax questions, and that's what Rex is great for. He's been with us for almost 20 years, right, Rex?
Correct.
Yeah, almost 20 years, been with us and with me and my wife, and we're so thankful for him. He's a great guy. He knows his stuff, and we are fortunate to have him. So listen to him on any tax stuff that he has, but also, too, stay on him about K1s. When am I going to get my K1? No. Anyway, thanks, everybody.
Thanks, Jay.
Okay.
Thank you, Jay.
Thank you.
All
Talk
right,
to you again soon.
Rex. So let's just wrap up here. I mean, let's go back to taxes, Rex. What do we have to say? What do you have to say for anybody who might be scrambling this year? What are a couple things they can do with their filings? What are things they need to keep in mind for next year?
Well, again, proper planning and implementation of those plans, because everyone is principally a cash basis taxpayer. And again, when it comes to participating in oil and gas, you have to pay for it now in order to have a deduction in the current tax year. So again, evaluating what your portfolio is, what proper allocations might be to establish an effective tax mitigation strategy by possibly taking a portion of your investable capital and participating in oil and gas that would give you active deductions, assuming that you elect to be a general partner. Then that will be an effective way to, quote unquote, invest at the wellhead. And for the cost of participation, of course, you have the initial outlay, but that is reduced by your tax saving. So therefore, your true net cost is much lower because of the tax savings is reducing your initial outlay.
Yeah. And, just to say this as well, there's a lot of people, and you might be listening and you're thinking, well, I've never really heard of the opportunities in oil and gas tax wise. And there are a lot of CPAs who are amazing CPAs, but they are more of just a tax preparer. They've actually never worked with tax strategies or investments, in related to tax opportunities. Rex and I have done a lot of, webinars with CPA Academy, really teaching and talking to CPAs about this. But, Rex, it's true. I mean, there's a lot of CPAs that are still unaware. So what is something somebody might be able to do if they, their CPA is not familiar with oil and gas benefits?
Well, the primary considerations, of course, is whether or not you have active deductions or if the deductions are subject to the passive loss rules. If they're subject to the passive loss rules, of course, those deductions are held in suspense until such time you have sufficient passive income, either generated by other passive income opportunities, which is typically real estate, or once our program becomes generating net taxable profits for passive income, those will absorb the losses that are allocated up front if you elect to be a limited partner. If you elect to be a general partner, then those losses can be used to offset any form of income, whether it be W-2 income, pension income, portfolio income, which of course includes dividends, interest, short-term capital gains, and capital gains. Any form of income that you might have other than passive income, the active deductions can be claimed to reduce your taxable income. And of course, this in the old concept is these were our deductions to arrive at adjusted gross income. The IRS has kind of stepped away from referring to adjusted gross income. Now it's just a reduction of your total taxable income if you look on line 9 of Form 1040. But in our particular program, we do have a conversion as of January 1, 2027, for instance, where you automatically become a limited partner. So that does two things for you. One, it mitigates your general partner liability. And two, because of that conversion, we will be generating more than likely net taxable income. And as part of that, because the partnership owns working interest, we would also have to allocate net self-employment earnings. But by having this conversion to a limited partnership status, we no longer have to allocate those net self-employment tax earnings. So at that point, you're not subject to that extra possible 15.3% burden on the income that you're receiving from our program.
Wonderful. And look, if you guys are watching and you're thinking, hey, I would like to work with a CPA that could advise me better on tax strategies, please, again, reach out to us at kingoperating.com. We have some incredible CPAs that we work with here at King. We would be happy to send you some referrals or some input on somebody who could help you take a look at not just our opportunity, but your overall tax situation and hopefully give you some good advice. So Rex, I think today it's just been just you and me here at the end, and want to thank everybody. Oh, I did almost forget, Rex, that we have a new segment coming up in the Upside newsletter that we put out, and that is going to be questions to Rex, questions to ask the tax guy. So you can actually send us an email, and you can email Rex at the Upside at kingoperating.com. You can submit those questions to him, and we may actually feature those in our tax section of the newsletter. So make sure that you subscribe to that. You can do it at kingoperating.com, where you can subscribe to the newsletter, and then you can email those questions to the Upside at kingoperating.com. All right, Rex, I'm going to start filling in my tax questions to you.
All right, sounds great.
Maybe I'll get.
Thank you for joining us, everyone.
Thank you, everyone, for being with us again this Wednesday, and we'll see you next Wednesday, same time, same place. Thank you, everyone. Thank you, Rex.
Bye-bye.